Well, just arithmetically, Tom, if real estate flattens out, and actually, I think the risk is that real estate prices are going to be going down as opposed to up. When you look at the latest unsold inventory numbers in the new and existing market, when you look at the CPI, a third of the index is related to residential real estate, 40% of the core is related to residential real estate. So it is actually very important. And I think it's going to act as a very powerful antidote to the inflation we're going to get on the goods prices side from all the tariffs.
David, I'm very curious as you look ahead to next week, and this is an extremely pivotal week in terms of economic data, in terms of earnings. We've got the Fed meeting as well, of course, Friday of next week, the deadline of that extension of the 90-day pause that President Trump put in place on those reciprocal tariffs. What are you watching for as that week unfolds? What's going to give you the best sense here of the relative health of the U.S. economy in light of all I just mentioned?
The most important thing next week is going to be the employment report. Because that is going to tell the tale as to whether the Fed is going to start to rekindle the rate cuts at the September meeting. That's really what we're waiting for. If we see cracks emerge in the labor market and we see a loosening up in the labor market, the Fed is going to feel quite a bit more relaxed that the goods inflation that we are seeing on the tariff file, if it doesn't feed into wages, that's going to be a comforting sign. So I'd say that the employment number in its entirety, the headline, the revisions, what the unemployment rate does, the participation rate, but also keep a firm eye on the wage number, because what's really important here, and everybody's waxing on about how great the U.S. economy is doing, I think it's rather mixed, is that real work-based income in inflation-adjusted terms is actually contracting. And
Right.
that is going to be where, the inflation from the tariffs is going to hit the wall on the labor market. So nothing, we know the Fed's not going to do anything. I think they'll keep their cards close to their vest in terms
Right.
of any guidance. The key is really going to be the labor market. That's what we're waiting for in terms of what it's going to mean for
Right.
interest rates over the next few
But
months.
then, David, on that real wage analysis, the inflation adjusted wage analysis, let's go to eggs. Lisa Mateo is going to Costco in the next 12, 18 hours to buy 42 dozen eggs just to get through the week. David, I'm looking at grocery prices. It ain't happening. Grocery prices are not coming down.
Well, that's actually a global phenomenon. I mean, the fact that agricultural prices are going up so much is global in nature and is actually, more related to climate change issues and the dramatic shifts in weather patterns than it has to really do with the tariffs. It's not just food, Tom. You've got furniture, appliances. I think you'll start seeing it in the auto sector, like goods prices in general in the next few months are going to be rising. The question is the persistence. And as I said earlier, the extent to which the service sector, and we mentioned real estate, the question will be the extent to which the service sector is going to act as a offset to what we're seeing in the goods part. But it's not just eggs. You're seeing more broadly based pressure coming on
Yeah.
goods. You mentioned food. That's weather patterns for the most part and disruptions from climate change. But the tariffs haven't had an impact yet, a big impact on the good side. That's coming in the next few months. I'm not convinced it's going to be sustainable. But more on top of that, and it came down to the earlier question, 60% of the CPI is in services, okay? And service sector is disinflating. The question is who's going to win that tug of war?